2025 has been one hell of a year so far. DeepSeek absolutely rocked the market on January 27th, sending many chip and AI-related stocks down 10 to 20% in a single day. Then the Trump tariffs got everybody's panties in a bunch, and just last week, Microsoft, Google, and Amazon all missed on their earnings, sending each of them down 5 to 6%. AMD missed and tumbled to 8%. Uber was down 8% before rallying over 10% to all-time highs. And then we have Palantir, who crushed earnings, guided higher, and is continuing its meteoric rise. We haven't seen this type of volatility in the market since banks started folding back in March of 2022. Amidst all this madness, several buying opportunities have presented themselves. And to be a successful long-term investor, these are the types of opportunities that we should be jumping on. So without further ado, here are my 5 favorite stocks to consider buying while the big names get all of the attention. First, we have PayPal, ticker PYPL. Yes, I'm going back to this well. I put it on my 5 stocks to buy on a dip list in 2024, and everything was going well. It went from $67 a share when I released my video all the way up to $89 before getting hammered this last week, even though they beat earnings estimates. And it's all because growth is starting to slow versus the last 2 quarters and guidance was light. This sent the stock down 12%. This company is in a rebuilding phase as they face stiff competition from the likes of Stripe, Square, the credit card companies, and even Apple and Google Pay. But this still is one of the most recognizable brands in payment processing in the world. And they own brands other than PayPal, such as Venmo, Braintree, Zoom, and Honey. Management guided for revenue growth in the 6 to 7% range, which isn't great, but not horrible during a turnaround phase. Cash flows are growing nicely and should continue to do so as long as the rebuilding process continues to go smoothly. Return on invested capital and profit margins are trending slightly upwards. In fact, one of management's primary focuses for the business is to direct less resources to low margin segments in the business and focus growth efforts on higher margin segments like branded checkout. And finally, they don't pay a dividend, but they've been on a buyback frenzy, purchasing 5 to 6% of shares outstanding over the past couple of years, ever since the stock crashed. This shows that management believes their stock is undervalued, and on their most recent earnings call, they reiterated their commitment to continue this torrid pace of buybacks, which will support their earnings per share growth over the next year or two. PayPal has an attractive valuation, trading at 15 forward PE, 2 times sales, and a free cash flow yield of 7%. Morningstar values them at $104, while CFRI puts a more modest $80 fair value estimate on them, but their 12-month price target is currently set at $100 per share. These DCF estimates imply this stock has anywhere from a 2 to 32% upside potential. Next, we have Hershey, ticker HSY. Hershey needs no introduction. We've all grown up eating Hershey's candies for decades. This is a wide moat company that's been pummeled over the past year. They're down 22%, and that's even after a 4.5% gain today on an earnings beat. However, be aware that management guided for earnings per share to be down a staggering 40% in 2025, almost entirely due to soaring cocoa costs. Cocoa prices have skyrocketed over the past year from about $2,500 per ton all the way up to $10,000, which will wreak havoc on your profitability when that's the primary ingredient in your products. They're also going through a CEO transition, which is weighing on the stock. The good news is that this is already priced into the stock, and they are temporary problems that will correct themselves with time. And because Wall Street institutions are all about short-term profits and constantly turning money, we have an opportunity to buy a high-quality company with significant competitive advantages at a 19 forward PE, 3 times sales, and a 5% free cash flow yield. I will say, though, there is one wild card, and that is what RFK does if he becomes HHS secretary. He has made it quite clear that he will take some significant steps to increase public awareness of the deleterious effects of junk food on people's health. Given that Hershey sells nothing but junk food, it makes me hesitant to take a position in this company, even though I like the price and their competitive position in their markets. They are by no means a high-growth company that will make you rich like Nvidia or Palantir. They are a reliable and mature mid-growth company that should produce strong excess returns on capital over the foreseeable future. Given their strong competitive advantages, they were growing their margins over the past 10 years until the kick in the crotch from the meteoric rise in cocoa prices. Their margins will take a massive hit in 2025, but once they can get those costs under control, they should return back to their old form of dominating the confectionery industry. The good news is that you'll get paid to wait with a 3.6% dividend yield, and there have been rumors that Mondelez recently made an offer to buy Hershey's, but their offer was rejected, most likely because it was a lowball offer. However, if a deal goes through at a significantly higher price, investors could reap the reward of a pop in this stock. This isn't the first time Mondelez has made an offer only to stop the pursuit of a buyout buyout, so it's unlikely that anything will come to fruition, but there still is a chance. Morningstar puts their fair value at $210, while CFRA places a $156 12-month price target on them, implying a 0 to 35% upside in this stock. Third on the list is AMD, ticker AMD. AMD is a direct competitor to NVIDIA in the semiconductor market. AMD has always treated me well, and I got to give a shout out to my brother on this when it comes to AMD. He was all over them all the way back in 2018 when it was trading around $10 per share. I bought into his thesis at the time, and after going up to $18 per share, I sold for an 80% gain. I got back in 2021 during a chip sector pullback when AMD hit $75, and I rode it up to $150 before selling and doubling my money. I haven't owned this stock since then, but once again, it's on a large pullback, and given its position in the chip sector and the price that it trades at, AMD is one of the stocks that I'm looking at for more of a short-term position. In all honesty, I don't think AMD is that great of a company. After a huge run-up in revenue from 2018 to 2022, they've stalled in recent years as NVIDIA expanded their stranglehold on the high-end GPU market that AMD just can't seem to crack. AMD is the leader in the CPU market, so I have no doubt that their revenues will remain elevated, but their cash flows and earnings are just too erratic and unpredictable for me to take a long-term position. All the while, they dilute their shareholders by steadily increasing their share count throughout their history. Having said that, they still have significant share in the chip market that is expected to grow from $600 billion annual revenue in 2024 to $1 trillion over the next 5 years. And as we've seen over the past 5 years, this secular trend will lift all boats in the semiconductor market, thereby benefiting AMD. Trading just over $100 per share, I think this is about as good a price as you're going to get to buy a piece of a top chip company and take a shot on a 30, 40, 50% gain over the next couple years. Morningstar and CFRA both put a $140 price tag on it, implying 30% upside in this stock. Fourth on the list is Nike, ticker NKE. Nike is another one that needs no introduction. What they do need are some new ideas. This stock has been crushed over the past 3 years as competitors like Adidas, Hoka, New Balance, and others have taken market share from Nike due to a huge strategic error of focusing on selling direct to the consumer in an attempt to increase margins. This allowed their competitors to move into the markets that Nike exited, which helped them get their product in front of customers. Nike also neglected product innovation, which has led to a stale pipeline of new products. There's no doubt that Nike is deep in its turnaround phase, and things are likely to stay bad for at least 2025, where double-digit sale declines are expected. But this is already priced into the stock, and they've found a new CEO. They brought back a longtime Nike veteran who's taking steps to redirect the company back to the iconic brand that it once was by refocusing on product development and innovation. This is in the range where investors should consider stepping in to buy the stock for the long term. They usually trade in the 25 to 30 PE range, but you can get them at a 20 PE, 2x sales, and nearly a 5% free cash flow yield. They haven't been this cheap on a free cash flow basis since 2010, and their shareholder distributions are great. They pay a 2.2% dividend yield, which has been growing at around 8% per year, and they've been buying back about 2 to 2.5% of shares each year for a 4 to 5% total shareholder distribution yield. Now, this probably will slow over the next year or two, but again, these expectations are based into the price of the stock. Even if they grow their dividends slower and buy back fewer shares, you're still getting a 3 to 3.5% minimum yield while you wait for the new CEO to turn the company around. Now, let's be clear, I'm not buying right here. As I stated in my deep dive on Nike, I won't be buying until they get into the mid-50s, but Morningstar thinks they're worth $120 a share, and CFRA projects that they're worth $72 per share, so this isn't a bad place to be buying. Now we move on to one of Nike's direct competitors and one of the companies that capitalized on Nike's mistakes, and that's Deckers Outdoor, ticker DECK. The maker of the UGG brand that women love and the super popular Hoka running shoe has done very well over the past 5 years, up 423%. But a beat and raise just wasn't enough in their most recent earnings release. Sales increased 17% year over year in Q3, and they raised their forecast to up 15% from expectations of up 12%. And the stock dropped like a rock. Year to date, they're down 18%, and it's all due to potential tariffs on China and to a much smaller extent the potential for slowing growth in their Hoka brand. If they can just get past the tariff problem, they're a fast-growing, highly profitable mid-cap company that is expected to continue to grow in the mid-teens. They're by no means cheap at these levels, trading at a 25 PE and 6x sales, but on a free cash flow basis, they're reasonable at a 3.8% yield, and they're creating significant shareholder value with a baseline return on capital of 25 to 30%. This could be a decent entry point, but Morningstar and CFRA both view Deckers as overvalued even after this pullback. CFRA values them at 165, while Morningstar is much lower at 120 bucks per share. The reason I'm a bit hesitant is the low barriers to entry in the footwear and apparel markets, and the fact that although they've been doing very well over the past 5 years, consumer tastes in footwear and apparel tend to change every few years unless you can establish an iconic brand like Nike did. Decker relies on their two main brands, UGG and Hoka, for 96% of their sales. So if the popularity of their Hoka brand dies down, the impact to the company would be significant. And I'm just not convinced that Hoka brand has long-term staying power yet. Well, those are the 5 stocks on a dip that I think are worth investors' time to take a look at. But I got a bonus company for you before we wrap this video up. I've been pounding the table for Adobe, ticker ADBE, for the past several months. They're down 30% over the past year, primarily due to concerns about their ability to monetize AI in their products, as well as the potential for disruption in the creative services industry as a result of AI and the text-to-video competitors that have popped up over the past year or so. But I'm confident in this fast-growing, highly profitable tech company that lives off recurring revenue and strong free cash flow generation. Earnings and cash flow have stalled over the past few years as they've ramped up capital expenditures to stay ahead of the competition in the AR world, but they're still generating a 28% free cash flow margin. Even after all the extra capital expenditures, they're keeping 28% of revenues to either reinvest in the company at high internal rates of return, or they can buy back shares. In fact, they just bought back $9.5 billion of shares outstanding in 2024, an all-time high. And they have another $14 billion in their share repurchase program to support their earnings growth in the coming year. They're trading at 21 times 25 earnings and only 19 times 2026 projected earnings, along with a 3% free cash flow yield. Even Morningstar and CFRA think Adobe is undervalued, with Morningstar valuing it at 590 bucks per share, while CFRA has it much lower at 474 bucks. Either way, this is a great entry point for a highly profitable, wide moat tech company growing around 10% per year. Well, that'll do it. I'd love to hear your thoughts on these stocks or any stocks that you think are a good buy on a dip right now. Do you agree or disagree with these 5 stocks? Are you buying any of these companies during their dips? If so, please leave it in the comments. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, if you're interested in other high-quality companies that could be good buys right now, click one of the thumbnails that you see on your screen. Till next time, you all take care. I'll see you in the next one.